Good morning, everybody. It's Hammer. Today is Tuesday, March 12th, 2024. I, of course, with Originator Success here with your daily rate update, the only place on the web where you guys get to be part of the conversation. Remember, you can join me live each and every day, 9:30 a.m. Eastern time as I do this with you. You can go ahead and watch the replay anytime you want. It's on Facebook and YouTube where it lives. If you are watching today, though, don't forget to smash that like button, tag an hello friend. Share us in a group if you're watching on Facebook. If you're watching on YouTube, go ahead and give us a thumbs up and subscribe. Don't get a lot of YouTube views, though. I probably should do something to promote this. Anyway, let's see what else we got going on this morning. You can go ahead and sign up for our written email lock advice to your inbox each and every weekday morning. www.ratelockadvice.com. You can also sign up for our text alerts at www.ratetextalerts.com. We send out alerts a couple times a day, once in the morning, once in the afternoon with a wrap up. And then any time that it's likely that we see a reprice worse, which is pretty possible today. So definitely consider signing up for those. They're a whopping $7 a month. Last but not least, if you can't beat us, join us. Join us at originatorssuccess.com. Find out how you can get loans from Google and social media. Find out the important things for thriving in 2024, what it takes to do this business, and also how we can help you to do it. So all of that said, let's say hi to the live folks. Who do we got here this morning? We got Ron Siegel, who has already pointed out that yes, they BLS has changed the way they calculate the CPI and more revisions are coming. They changed some things. Some of them have to do with shelter and stuff. Not too much of a big thing. It is a big thing, but then again, it's not a big thing. But I agree with you wholeheartedly. Definitely 100% on kind of the funny part about how all this stuff, but it happens all the time. We got Tim Klyla, Steve Lacefield, Megan Lindberg. Good morning, y'all. Scott Menser, Ernetta, haven't seen you in a while. Great to see you. Kyle Mazikas, good morning, sir. Great to see all of you here this morning, and thank you for joining me. So I have the wrong caption up because I clicked too quick, but sounds like a good place to start. Let's go ahead and look at the technicals. Let's take a look and see what's going on this morning. So the CPI data came out a little bit hotter than expected. If we want to actually look at the actual raw numbers, I don't have anything to flash on the screen, but let me look at I'm writing the morning advice, and it's my numbers. Here we go. I can go ahead and put this here. Let me copy this and paste it into Restream. And let's talk CPI data. There you go. All right. So the headline numbers were 0.4% in February over January. And that was very much in line with expectations. That's what they were figuring for, was 0.4. It was 3.2 annually versus 3.1 expected. So it was slightly higher than what was expected. When it comes to the core numbers, though, core numbers were 0.4, which is slightly more than the 0.3 projected. And we're up 3.8, which was also 0.1% higher than the 3.9% expected. Now, let's put the screen back on and we'll go over that. So the effect that we've seen, mortgage-backed securities net down about 14 basis points on the day. Not a huge drop, but definitely enough to put us in a position where rate sheets will be worse than yesterday. This is I was telling you to go ahead and lock yesterday. I thought that was a good shot that we would see this. That's what markets were looking at. I'm going to try to do this in a little bit of a linear fashion. Let me try to focus on this. But if we take a look, I'm a little surprised. I have to admit, I'm a little surprised at how negatively everyone is viewing this. One thing we got to be clear on, though. Inflation is not moving down fast enough at the CPI or the PCE that it puts the Fed in a position where they need to cut rates. That's the bottom line. The labor data showing some softness, but not enough. Arguably, when we see that unemployment number at 3.9, if we see that at the fours, that could be enough to trigger rate cuts because a lot of the Fed members don't want to see unemployment go above 4.1%. But other than that, I mean, we have a couple reports coming out this week that are still, we want to pay attention to. We've got consumer sentiment on Friday. We've got retail sales. This afternoon, we're going to have a 10-year treasury auction. Reprice risk on the day is moderate today. We could see this is worse. We want to be aware of that. So anyway, take a look though. Look at this. The all items is the headline number. So since June, we're in March, right? June of 23, it was at 3%. Then it went to 3.2 in July. Then it went to 3.7 in August. Then it went to 3.7 in September. Then it was 3.2 in October and 3.1 in November, 3.4 in December, 3.1 in January, 3.2 in February. So you're talking 0.1 higher. But the main thing is we really have not get better since June. You're talking 6 months of last year and 2 months, 8 months. It really has not been lower. And that's something that you could do it. They do like a 3-month average. They do a 6-month average. They do a 12-month average. But looking at the core number, though, the core number gets a lot more attention. That was food and energy prices, arguably more volatile, right? If we go back there, you're at 4.8. Then July was 4.7. Then you're at August 4.3. Then you're at September 4.1. Then you're October 4.0. Then you're at November 4.0. Then you're at December 3.9. January 3.9. February 3.8. So when you look at these core numbers, we're seeing very slow, consistent improvement, right? It hasn't gone back up. So it's kind of funny to me that when you look at this, and yet it's such a thing like that we're 0.1% higher month over month and blah blah blah. And I guys, I could dig deeper and give you the old thing that everyone else does in the spin and we could break down if we wanted to go into all the different sections of this here. We could go into the actual report and read it and break down all the different sections in here. I could say, hey, blah blah blah, and if we look at shelter and we do this and we do, I'm not going to go into any of that with you because it doesn't really matter. We could argue about this, that, the other thing. Let's look big picture here. Are mortgage rates going to improve anytime soon? No, they're not. There's no clear evidence that the Fed needs to cut rates yet. We know there's a lag, right? If the Fed were to see that the economy is tanking, they're already too late to start cutting rates, but they're not in a hurry because they don't want to see inflation move higher, because it would be worse to have to raising and hiking that Fed funds rate and really throttling the economy because inflation starts to grab hold again than it would be if they need to just stay higher for longer, as they call it, push the country into a bit of a recession. Now we could get into the argument, what is a recession and all these different things. Bottom line, people are out spending money. I go to a restaurant, it's full. I go to a hotel, it's full. I get on an airplane, it's full. I go to a play, it's people are spending money. It's just the bottom line. Whether it's poor people, rich people, class people, I don't know. But there's money being spent, and that's why we're not going to see anything, go on there. We really need to pay attention to what this does for expectation of Fed cuts and what it's going to do for mortgage rates. Because that's what we're here for, is mortgage rates. We're not traders. We're not bond traders. We don't need to go into all this different stuff, right? When you look at the expectation of a Fed rate cut in March next week, it's at 99% that it's going to stay. No Fed rate cut. It was 97. It got slightly worse. This is a big move, though. Look at this in the idea of a May cut. I mean, a month ago, it was a 40% expectation that we would see rates remain the same. That means there was a 60% expectation to see rate cuts in May, either a 0.25%, or there was an expectation a month ago that maybe it would be the second rate cut. Now it's all the way down to 9%. Okay, so markets are not expecting to see a rate cut in May either. No cut in March, no cut in May. June, it's about the same. It was about 25%. This is actually getting worse on the morning. Now it's at about 33%. That's not that big of a difference. That means that there's 70% probability and expectation that we're going to see a rate cut in June. Markets believe that we'll back up by July. It goes up to about 85%. And look at the idea that we could see 2 cuts. Now, I think that this is too optimistic. I do. I don't think rates are going to go much lower than here next couple of months. We're going to see a little bit better rates today, but not much. Why? Because the expectation, we're not going to see rate cuts until maybe July. However, markets pricing by the end of the year, we're at 5.25. The idea that we'll have 3 rate cuts would bring us to 4.5. Well, there's a 30% expectation we'll be at half. There's about a 20% expectation that we will be at 4 3/4, 15% really. This would be 2 rate cuts. This would be the 3 rate cuts. There is a third that believe we'll see 4 or more rate cuts. This is 30, 45%. Almost half believe that the Fed is going to have to cut rates more than 3 times, or if they do cut 3 times, they're going to have to be more aggressive and bring it to 4 1/4. That's not what we see in the dot plots. The dot plot calls for 4.5. We're going to get another dot plot at this meeting week, and I'll talk more about as we're going over the next couple of days. But if that dot plot, right now, there's no reason for the Fed to think, hey, we're going to have to cut rates more aggressively. It's just there. So, Ron, let's see what Ron has to say on this. And oops, let me put my chat. Here we go. Let's see. So, Crystal says 100% are they're maxing out those credit cards, spending like crazy. I'm not saying that they're making the money, but they're definitely spending the money. Good morning, Yadis, Allison Foy, Yasmin Martin, Rob Stewart, Mike Tebow, Nathan Einkorn. Great to see all of you guys here as well. Ron Siegel said the Fed might wait for the BS report to show a real unemployment number. Challenger report shows Apple to start reporting buy now, pay later to Experian. The current recession will help our rates. Again, let's define a true recession. A recession is when people aren't spending money and they're afraid they're going to lose their jobs. And I don't know that that's really the thing. There's a lot of complexity to this. Ron said, did someone say July, November, December? Yes, Mr. Ron Siegel did. He did. You did say, July, November, December. I still think we're probably going to see a June cut. I think we need to see some data to support it. But I think the Fed, I don't know, I just like the symmetry of June, August or September, skip November and December. I just like that symmetry of a June, September, December month in between. I think the Fed likes that too. Good morning, Thomas Wolf. So anyway, as far as all this, and we could go into, like I said, we could go deeper into this stuff. I could read this to you, blah, blah, blah. We could look at these and, charts and talk charts. But at the end of the day, let's go back to what we do here and let's talk rates. And let me pop this up on the screen and then we're going to wrap it up for today. So talking rates here. All right, here. By the way, are any of you going to the Difference Maker event that I'm speaking at in Atlanta tomorrow? Just curious. We had posted that out there. Mr. Austin, great to see you there. Amy Santiago, what's up, man? Jerry Avila, great to see you. Taking a look here, let's look at mortgage rates, right? So 6.85, 6.92, 6.87, high sixes, base high sixes. This is generally the best we're going to get. We're not poised to see much better. Now, where does that put us as far as locking flow, that stuff? Let me pull up my email broadcast over here real quick so you guys can see what I'm working on. There you go. So this is the email that I didn't get it. I have to send it out in a minute, but I'm still in that same stance. I'd be locking anything closing the next couple of weeks. We've got retail sales. We got consumer sentiment. How much of a pickup could we get? I mean, if they show a little bit weaker data, is that going to swing anybody to think the Fed's going to make any different moves next week? No, not really. It was all about the CPI. So those reports will have some intraday trading, but not enough to any kind of a jump or whatever. We've got that 10-year Treasury auction this afternoon. Be aware for it. It could send bonds spiraling. Bonds are already on the weak side. They're bouncing off. If we look at the technicals there, if we take a look at the actual technicals here, we're down 17 basis points. We could argue that we're going to test this line right here, this red line. That's the 50-day moving average. I don't think it's going to give us a strong support level. I don't think there's reason to see much support on this. I think markets, we're going to trend lower from here. I think we're going to see bonds lose ground heading into next week's meeting. We got to really nail up, but between the BLS and the CPI, it's just not giving us the strength we need. And I think that that's now going to see that move away. We've seen the expectation of Fed rate cuts to, kind of slide out from underneath us. And I think that puts us in position where bonds are going to do the same and rates are. I don't think 99.52 is where we're at now. The 50-day moving average 99.53. So we're arguably right at the support level. And we could say watch it through the day, see if it gives support, see if we get a bounce. I don't think there's much of a reason for a bounce. That's basically the thing that's going on. You look at the 10-year Treasury yield, that's got to catch your attention. We were down to 4.08, right? We were down to 4.08 here. And now it's, yesterday we were at 4.10, 0.15, and we'll see if that drops back down. But the same argument, see this red line?
Let's make this a 1 month so you can see it clear. Look at this. There's a 50-day moving average here. It was 4.12. This would arguably be a support because remember on yield, this is 10-year yield. We don't want it to go up. We want it to go down. So the pushing up, we would test this as a support level. Do I think it's going to give us any support? No, I don't. I don't think it's going to give us any. And I don't think we're in a position to see things back down. What would have to happen for rates to improve from here? It's going to be the meeting on the 20th of the press conference, more specifically the press conference, something that they can grab onto that gives them the idea that the Fed is thinking of cutting. And we're in a Fed blackout period. Fed members are not allowed to speak. There's no public speaking until the actual Fed meeting started on Saturday. Remember, before the meeting. And so the Fed members are muzzled. They're not going to put anything out there. We're sure to get a kind of a little Fed wing from Nick Timiraos over at Wall Street Journal. But at the end of the day, we don't have things really significantly improved from here until we get to that meeting. And I think we could. I mean, markets, we're not going to see rate move up high from here. We're not in a rising rate environment. Rates can move higher, don't get me wrong, but higher as in the same 7.25-ish that we were pushing up to here. We're not going back to October 2023 highs, but we're also not going to 2023 lows either. That was when markets were celebrating the Fed pivot, and the expectation was that we would see rate possibly in March at this meeting that's coming up now. That was when we saw the best mortgage rates. And look at the spark that gave the housing market. Now we're headed into the or the spring market here. We need to see a little bit of love. And I think this is it. We're in this half point realm between 6.75 and 7.25, and we're going to be pushing again LLPAs. And I'm just using like the kind of mortgage news daily bullet point. Ron Siegel discussed huge red flags in the VIX charts with the stock market tanks. What will that do for rates? That's a great question, Ron. I'll tell you what, when it comes to, I'm going to leave that up there. When it comes to the stock market stuff, remember what it used to be? I mean, 20 years ago, it was like stock market goes down, rates, the bump, which is good for rates. That's not the case anymore. A lot of times you're seeing a lot more balancing to portfolios. If stocks go up, they kind of grab bonds and pull them along on their coattails. We do see that. If the stock market tanks, I don't think it's going to be good for rates. I don't think it's good for rates at all. If the stock market tanks, it's going to create a lot of fear. Money is going to tend to go into more cash bonds. There's not a lot of reason to push things into bonds, especially when you put all that other stuff. So, but I think there's a lot of volatility in stocks, but I don't think that they're going to crash anything huge. Robert Bashirs, he definitely has hit the nail on the head too. He said people are overspending because they're accustomed to living like they have money, like 2020 post-COVID. The problem is that money they had stockpiled has run out, but the habits have been developed. And you're absolutely correct on all that. And it goes deeper than that. Banks are making money. Banks operate on cash flow. The fact that the debt continues to rise, the actual principal debt continues to rise, doesn't matter. As long as people are paying their bills within a certain amount of time. I would say on time, but even if they're late, they'll collect late fees. They'll collect that interest as long as they're not going belly up in bankruptcies. If bankruptcies jump, if these credit card companies, banks that are lending this money start to lose big chunks of money, that'll slow things down. But otherwise, look at cars slowing down, new cars, old cars, car loans, all those things slowing down. So you've definitely got that. Mike Thibault said, when do gift cards count in retail sales? When they're bought or used? I would assume when you're looking at the goods that are sold. So that's my take on it. I don't know. It's a great question, but not a big answer for you is what I got. So, all right, I'm going to Atlanta later today. I'll be in the car, chatting with my man Austin. We'll be talking about some new content for Originator Success. You guys should definitely go check us out over there. Tomorrow morning, I will do my best to hop on and be live, but I'm going to be at an event, so it might be a little bit shorter and a lot of, again, I've been on for 20 minutes today, so I won't have a lot of new stuff to say tomorrow. So keep that, but I will do my best to get on there at the normal time and say my piece. And again, I mean, really, I'm leaving it just like we got here. Anything that's 30 days out or more, I would float. I'm not worried about seeing rates move a lot higher from here. Could we see them push up to 7.25 again? Absolutely. Conventional conforming, blah, blah, but basically where we were a week and a half ago. But I think it's kind of our high tide line. I'm not worried about rates going much higher than that. Unless we were to get a really bad report in April and I'm just not really going to go there yet. Let's see where this Fed meeting goes first. Anything closing in 15 to 30 days, let's float into that Fed meeting and see where things go. I mean, those Fed press conferences can really help us out if we get if Powell says some things. Allison, I did say Atlanta. I will be in Atlanta. There's an event. I'm speaking at an event, 2020 Vision for Success Coaching, their difference maker mastermind workshop there. So I'll be speaking there tomorrow. So I am driving out there today. Also having dinner with some folks over that way tonight. So tomorrow, I'm sorry, not tomorrow. For loans closing in 15 days, I would lock. Why? Because I'm looking at my calendar over here. Today's the 12th, right? It's a week away to get that data, and it doesn't. I don't have a lot of hope that we'll see a lot of improvement, and I think we could see rates worse in between now and then. I think we're going to continue to see this trend happen over here. I think we're going to continue to see the 10-year treasury yield creep higher, and I think we're going to see mortgage bonds continue to come lower. We could argue about this technical support level, blah, blah, blah. I don't think it matters. I think we're going to see bonds start to creep down. We picked up a lot of ground, and that was awesome, but I think we can lose ground, and I think that we will be going, what does this cap out at? Around 99.20? I think we could get down to about 99.20. I think we could lose another 30 basis points. So I would consider locking anything closing near term with that in mind. All right, my friends, I'm going to wrap it up. Thank you so much for joining me today. Appreciate you. Remember, I'll be here tomorrow, 9:30 a.m. Eastern time. At least I'll be doing my best. You'll definitely see me on Thursday, 9:30 a.m. And I will see y'all in the future. Take care. Make it a fantastic day. Bye-bye.